All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Wednesday, everybody. Today is February 5th, 2025, and it looks like we've got another rough day for tech stocks ahead of us based on some big tech earnings. Last night, we got earnings from Google parent company Alphabet and from AMD, Advanced Micro Devices. And well, both companies posted pretty impressive numbers, earnings beats from both of them, very impressive year-over-year growth from both companies. But that growth, it's not just about maintaining that growth, it's about growing that growth. And while the companies are no longer growing their growth is actually shrinking. You guys following all this? You following along? The problem is these companies are victims of their own success. They have done so well for so long. The stocks are priced as if that growth is going to stay that way forever. And sooner or later, the law of large numbers takes over and you can't keep it up forever. Case in point, Google's earnings, right? Google's cloud revenue came in up 30% year over year. Taken in a vacuum, that is a magnificent number. 30% top line growth for a cloud business is great. You should be proud of that number. The problem is last quarter, it was 35%. See the problem there? Slowing growth. And when you've been priced for perfection, well, that's not so good. And so Google stock is being sold off because of that. We saw the same thing with Microsoft earnings earlier this month. Microsoft reported 31% growth in their top line segment versus 33% in the prior quarter. And Microsoft stock sold off on that. So we're seeing this consistent theme of slowing growth in the big tech names, and it's really hurting them here. Also, Google announced that they are going to forecast $75 billion worth of CapEx spending for 2025. So this game of CapEx chicken between all the big tech companies, where it's a contest to see who can light the biggest pile of money on fire, it continues right now. And, in a game of chicken, the way it works, whoever comes to their senses first loses, even though if nobody ever comes to their senses, you eventually crash face first into one another and you all die. But so far, big tech has been reluctant to slow down this big CapEx cash burn. So Google saying 75 billion, and investors are saying, where's the return, guys? Where's the beef is basically what it comes down to. So Google stock is down big this morning. That's going to have a drag on the S&P and the NASDAQ. Also, we got earnings from AMD came out last night. Again, it was a earnings beat on the bottom line, but data center revenue missed despite a total revenue beat. I mean, overall revenue at AMD was good, 7.7 billion versus 7.5 billion expected. But that data center revenue number, 3.86 billion, that came in below the 4.14 billion the market was hoping for. So a slowdown in data center revenue among one of the big semi names, that's not something this market is priced for at all. So AMD stock is down almost 10% on this news. Also, shout out to my friends over at the Coastal Journal who put out something last night pointing out, we'll say, an accounting red flag. It's not necessarily fire, but it is smoke. We are seeing consistently rising accounts receivable at companies like AMD specifically. In this case, accounts receivable is going vertical while free cash flow is going down. And while that's not always a sign of accounting fraud, whenever there is accounting fraud, there's usually that, right? That's a sign of things like channel stuffing, like maybe they are prematurely booking revenue in order to keep maintaining these revenue numbers. While at the same time, you can play accounting games and gimmicks with your top line, with your revenue numbers, but you can't fake free cash flow. Again, it's smoke, it's not fire, but it's something that's worth keeping an eye on. AMD stock is getting clobbered this morning. Also, we got a trade war update. The Chinese are going after Apple now. Yesterday, it was NVIDIA and Intel. And who was the other one they were going after yesterday? There was a third one. I can't remember. Maybe Google yesterday. Today, it's Apple. China has announced that they are probing App Store pricing, in particular that 30% commission that Apple charges for in-app purchases. Well, it's another shot across the bow, if you will, or another retaliation to those tariffs that Donald Trump put on Chinese goods. So we've seen a little bit of movement on the Canada and Mexico front, not a lot on that Chinese front. So far, the Chinese are just firing back. By the way, guys, you may notice my throat's still a little coarse this morning, but we are doing better. Shout out to all my melon heads who recommended this stuff, this Buckley's. I've never heard of this, but it comes in a bottle that looks like a whiskey flask. It might as well be whiskey because this stuff clears you right out. It's like somebody took Vicks Vapor Rub and mixed it up with seawater and said, yeah, it's a good idea. Let's drink this stuff. It tastes terrible, but man, does it clear you right out. So thank you for everybody who recommended that stuff. All right, back to our regularly scheduled programming. We've also got earnings from Disney this morning. Disney posted pretty good results. Their streaming business, the price hikes on their streaming platforms appears to have more than offset a loss of about 700,000 subscribers. So whereas Netflix posted some pretty marvelous subscriber count growth in their previous quarter, Disney is still losing people, but they're charging more to the people they still have. And so their overall business is still growing in streaming. Also, movies did pretty good for Disney. They got a little boost from Moana 2 this quarter. Parks was flat overall. Disney stock not really moving very much. It's up about 1% pre-market. Uber was interesting this morning. We got results from Uber. It was a big earnings beat. I mean, a massive earnings beat. The problem was it was all taxes and accounting gimmicks. If you take all that away, you're left with net income. That was actually a big miss. Operating income for Uber was just $770 million versus expectations of $1.15 billion. So if you get rid of all their little accounting gimmicks and, they're booking earnings from their investments and this tax realization or whatever they're calling it, you're left with a core business that is not doing so well. So Uber stock is being punished this morning. And we also got a lot of jobs data here. We've got JOLTS came out yesterday. The number of job openings in the United States declined by more than 500,000 in the last month. Some continued sign of weakness in the labor market there. Job quits, however, rose by about 53,000. That's a little bit optimistic. More people quitting their job generally indicates people have more confidence they'll be able to get a new job. And just this morning, we got ADP private payrolls that rose by 183,000 versus expectations of 150,000. So that's some slightly bullish labor data there. And of course, this is all leading up to this Friday's non-farm payrolls report that comes out Friday morning. That is arguably the single most important economic data point that we get every month. And with that, why don't we shrink my big melon of a head and let's see what's going on in markets this morning. And guys, if you don't mind, if you could hit that like button for the YouTube algorithm, I sure appreciate that. And if you're new here, hit that subscribe button so you could come back and have your coffee with the melon heads, because we do this every morning. And again, I don't usually sound like this. I've just been under the weather for the last couple of days, not weeks. And right now, the S&P 500 is down about 15 points or 0.25% lower, well off of its lows of the morning. We were down quite a bit more than that earlier today. The Dow, meanwhile, has actually snuck into positive territory while I was talking here, up 2 points, a respectable break even for the Dow at the moment. And the NASDAQ, however, leading the way lower. Those Google and AMD earnings are weighing on the NASDAQ this morning, down 138 points or 0.64% lower for tech stocks here. Meanwhile, the U.S. dollar is sharply weaker this morning, back below 108. The Dixie has made one heck of a round trip this week. Remember, we were almost 110 on Monday morning at one point. Now we're at 107.54, down 47 basis points or 0.44% lower. Looking over at the bond market here, we've got lower yields. Remember, guys, lower yields means higher bond prices. So we've still got something of a flight to safety going on in the long end of the yield curve this morning. The 30-year Treasury, 4.695. That is down 5.3 basis points. The 10-year yield is at 4.462. That's also down 5 points. The 2 years at 4.205, down almost 1 point. And the 1 month is unchanged at 4.310. Looking over at the commodities board, we've got another all-time high for spot gold this morning, up another $23, 2,865 for spot shiny. That's 0.8% higher. Again, that slow flight to safety, we'll call it. It's not a stampede to safety yet, but we are seeing a slow flight to safety this week. We're seeing gold slowly march higher to new highs. We're seeing yields moving lower on the long end of the yield curve. That is indicative of investors looking for safe havens. Spot silver, meanwhile, $32.23. That's up about 10 cents or dime this morning, 0.32% higher for silver. I like the shiny. Copper is up about 0.1%. Platinum is up about 1/3%. Palladium is essentially unchanged here. WTI crude oil's at 71.77 for March futures. That's down about 90 cents or 1.3% lower. Meanwhile, we've got Bitcoin is still kind of hovering here in the high 90s, low 100s. Important technical notice here. We're at 98,460 on Coinbase right now. Absolute price, not such a big deal. The important thing is watch that 50-day moving average. We lost that this morning, and it appears to be acting as resistance right now. So keep an eye on that one right now. Bitcoin has not fared so well these last few days as investors have been fleeing risk assets for the safety of the bond market and gold. Now, let's talk about some of these big earnings that came out. First and foremost is Google parent Alphabet. Alphabet earnings beat expectations, but why the stock is tumbling. By the way, guys, we got a lot of Barron's articles this morning. For whatever reason, Barron's really bought their A game today. So we're going to be visiting Barron's a lot today, more than usual. Alphabet stock tumbled 7% ahead of the open of trading on Wednesday after earnings from the owner of Google beat Wall Street expectations but fell short on revenue. Cloud revenue growth decelerated in the fourth quarter, jumping 30% from a year earlier to $12 billion, but that's after rising 35% in the previous quarter. It also missed analyst estimates of 12.2%. And it's that slowing growth there, guys. Even though 30% top line growth is really, really impressive, when you grew 35% last quarter, investors are somewhat spoiled from that, and they're going to be disappointed by that number. It comes after Microsoft said on January 29th that revenue in the second quarter from Azure and other cloud services increased by 31% compared to 33%. Microsoft also sold off on that news. D.A. Davidson and Gil Luria said Alphabet's disappointing earnings were underscored by a miss on top-line expectations and decelerating cloud growth. He maintained a neutral rating on the stock with a price target of $200. Now, this is from Google's CEO, Sundar Pichai here. He's saying, we are confident about the opportunities ahead, and to accelerate our progress, we expect to invest approximately $75 billion in capital expenditures in 2025. CEO Sundar Pichai said in the earnings release, massive spending on generative artificial intelligence has been a continuing theme. However, viral social media posts last week said that DeepSeek had developed an AI model similar to OpenAI's ChatGPT for significantly less money than what U.S. tech companies have spent on AI. Experts have since decided the cost was likely higher than what has been reported, but there are still those who question whether tech giants need to keep spending as intensely as they have been. So what they're talking about here, guys, is there's been a lot of discussion back and forth about whether DeepSeek used the 50,000 H100s some are claiming or the few hundred H800s that DeepSeek is claiming. The answer is probably somewhere in the middle. DeepSeek obviously did use some of the advanced chips. I did a whole video over the weekend about how it's laughable how NVIDIA and Supermicro are just totally sidestepping these export controls. And they've sold so many of these advanced chips into China that there's now an absolute surplus of them in the market, and they're being dumped on eBay and even Facebook Marketplace. So obviously DeepSeek used more chips than they're advertising. That being said, some very sharp people and some very technically proficient people have written a lot of articles who have said, maybe the training was a little bit more cost intensive than their advertising, but the efficiency breakthroughs that they made at DeepSeek are legit, and they have been able to reproduce that here in the States on far less sophisticated hardware. So it is questionable how much of this big CapEx spending on data centers can they really keep doing here. At this point, it's almost like they're still going through this cash burn just for the sake of doing it, because they know the second they stop, their stocks are going to sell off like crazy. Again, guys, it is a game of CapEx chicken. Alphabet stock this morning down 6.8%, trading at $193.58. That's off by about $14. That is going to weigh on the larger NASDAQ index for sure. Also going on this morning, AMD stock plummets on AI and data center revenue miss. Are you guys noticing a shift in the sands here of the headlines? I mean, since when do we see things in headlines like AI data center revenue miss? Not a good indicator for this AI mania, I can tell you that. Advanced Micro Devices reported better than expected earnings results Tuesday afternoon, but soft data center revenue sparked a sell-off in the stock. The semiconductor company reported fourth quarter adjusted earnings per share of $1.09, compared with Wall Street consensus estimates of $1.08, so just barely beat earnings here. That's according to FactSet. Revenue came in at $7.7 billion, which was above analysts' expectations of $7.5 billion. But in the December quarter, the chip maker's data center unit generated $3.86 billion in revenue, which was below the $4.14 billion estimate. And that right there, that is the number that's killing AMD this morning, that $3.86 billion in data center revenue versus $4.14 billion estimated. AMD shares plummeted as much as 9% to $108.72 in pre-market trading. And I got to send a shout out to my friend, the Coastal Journal, who sent me this one on X yesterday. And this is a very good question that the Coastal Journal is raising here. This is talking about some AMD numbers. And the Coastal Journal says rising accounts receivable versus declining cash flow. Now, accounts receivable, guys, that is orders that the company has received that they're booking as revenue, but they haven't been paid for yet. And then, of course, cash flow, that's basically the difference in your bank account at the end of this quarter versus the previous quarter. And so you can fake accounts receivable. You can pull orders forward. You can take credit for orders that may or may not ever materialize, but you can't fake the dollars in the bank. And whenever you see a big divergence in these two, it's not a perfect indicator, but it very often does indicate some type of accounting shenanigans going on. And this is one that is definitely worth keeping an eye on because this gap has been growing for over a year now. Shout out to @OneCoastalJournal on X for sending me that one yesterday. That is a very good spot there. Thank you, Coastal Journal, for sharing that information. AMD stock is currently at $107.88. It's down almost 10% here, 9.75% lower, off by $11.62. Also going on this morning, Apple stock falls, blame U.S.-China trade tensions. Seems Apple is in the crosshairs of the CCP this morning. China has been a weak spot for Apple for some time. Trade tensions between Beijing and the U.S. certainly won't help. Apple stock fell early Wednesday after a report said that China is looking into probing the iPhone maker's Apple App Store fees and practices. Apple shares fell 2.5% to $226.90 in pre-market trading Wednesday, while tracking the NASDAQ was down about 1%. China's State Administration for Market Regulation is preparing for a potential probe into how Apple deals with developers, including its 30% commission on in-app spending, according to a Bloomberg report citing people familiar with the matter. There's those people familiar with the matter again. Those guys got their fingers in a lot of pies, don't they? Apple stock is down 2.2% on that news, trading at $227.68, off by about another $5 here. All right, let's talk about Disney. Meanwhile, there was a lot to digest in Disney's earnings, but overall, it was pretty good. Disney stock rises after earnings. Streaming price hikes help revenue top expectations. Walt Disney stock was rising Wednesday after the entertainment company's fiscal first quarter earnings report showed that its decision to hike streaming prices has paid off. Shares were up 1% to $114.40 in pre-market trading. The gains came after the House of Mouse's direct-to-consumer segment, which includes the streaming services Disney Plus and Hulu, reported its first ever December quarter profit. Operating income for the division rose to $293 million, compared with a loss of $128 million a year ago. So that's a pretty big swing there, from a loss of $128 million to a gain of $293 million. Analysts were forecasting operating income of $172 million. So there's a big beat there for operating income. Disney raised the price for Disney Plus and Hulu subscriptions in October. Fewer customers ditched the platforms than Wall Street was expecting. Disney Plus lost 700,000 subscribers. I guess they're going to have to change the name to Disney Minus pretty soon. Narrower than the loss of 1 million that they were expecting. Now, that is the second consecutive quarter of subscriber losses for Disney Plus. And again, contrast that with one of the biggest quarters ever of subscriber gains over at Netflix. This is probably not a sustainable trend here for Disney. Disney Studios and sports segment also swung to a profit from a loss, thanks to the box office success of movies like Moana 2 and a 50% uptick in domestic advertising revenue for sports channel ESPN. Operating income for the experiences division, which includes Disney's theme parks, was flat within a year ago. Parks took a $120 million hit from Hurricanes Helene and Milton, and the launch of the Disney Treasure cruise ship in December drove up the segment's costs. So overall, Disney earnings being seen positive here. The only real negative was that 700,000 subscriber loss, but all the other good news appears to be overwhelming that here. The stock is up just under 1%, $114.35. That's up by about $1.05 this morning. Now let's talk about Uber, where, if you just read the top line, you think Uber was doing really good, but this is why you have to open up these financial statements and actually look at what's going on under the hood. Uber stock falls after earnings and gross bookings outlook disappoints. Uber stock sank in pre-market trading Wednesday as the ride-hailing service reported mixed fourth quarter results. Revenue of $12 billion for the December quarter rose 20% from a year earlier and surpassed Wall Street calls for $11.8 billion. While net income jumped to $6.9 billion in the fourth quarter, Uber said this included a $6.4 billion benefit from a tax valuation release. And I'll be honest with you, I don't know what the hell a tax valuation release is, but apparently it made Uber $6.4 billion last quarter. That's along with a $556 million benefit due to net unrealized gains related to the revaluation of its equity investments. So if you look, Uber's net income of $6.9 billion, and then they're saying, okay, $6.4 billion came from this tax gimmick, $556 million came from unrealized gains on equities. Well, that's pretty much all of their net income, isn't it? The ride-hailing platform also reported operating income of just $770 million, which sharply missed analyst calls for $1.15 billion. And that's the rub right there. If you take away the tax valuation release, and if you take away the unrealized gains from their equity investments, you're left with a ride-hailing platform that's making about half as much money as Wall Street expected. And Uber is paying the price for that one. The stock's down almost 5% pre-market here, trading at $66.32. That's off by about $3.43 this morning. Rough morning, pretty much all around for tech stocks here. Now, let's talk about the labor market, guys, because we have an important data point coming up on Friday. We get that non-farm payrolls, aka the jobs report on Friday. And typically before the jobs report gets here, we get some other smaller indicators that give us some clues about what that jobs report might look like. And we got this one yesterday, the JOLTS report, or Job Openings and Labor Turnover Survey. This counts the number of jobs posted in the United States, and job openings in the U.S. fell by 556,000 to 7.6 million in December, missing market expectations for 8 million and indicating a gradual cooling of the labor market. So you can see here, we had seen 2 consecutive months of growth in JOLTS. In particular, that November number was really good. And well, it appears that's short-lived because we're heading lower again. And if we zoom this out to about a 5-year chart, you can kind of see how the job market has just been slowly bleeding out openings here since the peak in 2022, right around the time the Fed started quantitative tightening. And you'll also notice that we are still not back down to the lows that we saw pre-pandemic. And well, that's because of the work from home and multiple job postings and this phenomenon of ghost openings, jobs that are posted, but they're not really hiring for. We still don't know how many of those there really are out there. I suspect the number is several million, though. Meanwhile, we got job quits, which also comes out with the JOLTS report, the number of people voluntarily leaving their job. The number of job quits in the U.S. increased to 3.197 million in December. That's from an upwardly revised 3.13 million in November. Now, more people quitting their job generally indicates a healthier job market because people have more confidence they'll be able to find work elsewhere. Now, I'm not going to celebrate this number too much because you can see we're still kind of settling into this new low area. Yeah, we're up from the lows that we saw in November, but not by all that much. And if you zoom out by 5 years on this chart, you can see here, this was the great resignation that we heard so much about in 2021 and 2022. And much like job openings, job quits has been falling steadily for like the last 3 years. And last but not least, this morning, we got ADP private payrolls. Now, this number somewhat mirrors the jobs report we'll get on Friday, but this is private sector payroll data, not compiled by the Government Statistics Bureau. And ADP sometimes varies pretty wildly from the non-farm payrolls, but it's another clue on what the jobs market looks like. Private businesses in the U.S. added 183,000 workers to their payrolls in January of 2025, and that is higher than the upwardly revised 176,000 in December and above forecast for 150,000. Hiring momentum in Q4 carried into January with some exceptions, including manufacturing. We had a strong start to 2025, but it masked a dichotomy in the labor market. Consumer-facing industries drove hiring, while job growth was weaker in business services and production, said Nella Richardson, chief economist at ADP. The service-producing sectors added 190,000 jobs, led by trade, transportation, utilities with 56,000, leisure and hospitality with 54,000, education and health services with 20,000, and information with 18. Professional business services added 14,000, and financials added 13,000. The goods producing sector, though, lost 6,000 jobs due to manufacturing, minus 13,000, which offset job gains in natural resources and mining and construction. Meanwhile, annual pay growth for job stayers was 4.7%, and pay growth for job changers was 6.8%. So those pay numbers are a little bit encouraging there. That is somewhat higher than the inflation statistics that the government has been putting out. So at the very least, workers are catching a small break after several years of being bludgeoned over the head by inflation. And you can see ADP payrolls here pretty much in line with some of the previous month numbers. Not really any big outliers in this report here, all leading up to that all-important jobs report on Friday. And I just want to say thank you very much to M&J. Thank you so much, M&J, for everything you do for the channel, who gifted 10 Nobody Special Finance memberships. Guys, if you got one of those memberships, be sure and let M&J know in the comments your gratitude. And once again, M&J, thank you for everything you do for the channel. And still have not received my Dirtbaggery t-shirt, I might add. Disappointing performance by our folks over at Spring, which is why we had to ditch the merch store. Sorry about that, everybody. Thanks again, M&J, for supporting the channel. And Armando Reyes, thank you, sir, for the super chat. Armando says, worldwide economic news is getting kind of boring. I need some shock and awe in my life right about now. Armando, be careful what you wish for, brother, because eventually you're going to get it. Boring, probably not the word I would use. It's been pretty, I don't know if exciting is the word I would use either. Ever since DeepSeek came out, man, there's been a really big change in the narrative. And I would say even before DeepSeek came out, I'd say ever since the end of December when Satya Nadella, the CEO of Microsoft, made that comment about no longer being chip constrained and now I'm power supply constrained. Ever since then, I have noticed a little bit of a shift in the tide. It was very subtle at first with just those little comments from Microsoft. And then Microsoft delayed one of their data centers. And then, Microsoft stuck with their CapEx numbers, but they said, yeah, 2026 might be a little bit lower. And now we're starting to see these slower growth numbers from companies like Google, companies like Microsoft, companies like AMD, and of course, DeepSeek. All of this data center build out, all of this wild, just contest to see who can throw the biggest pile of money into the fire. This is all going up in smoke ever since DeepSeek came out. Now, some of DeepSeek is obviously hot air. I'm sure it costs more than $5 million to train that model. But that being said, there are some very bright people who are putting out research papers who are saying, yes, DeepSeek is legit. We have reproduced what they've done in our lab, and we can run their large language models on local hardware without these supercomputing data centers. And think about what that means for the, $500 billion that has been pumped into data centers in the last 2 or 3 years. Boy, there's some big write-downs on the horizon if that ends up playing out. So I don't know if boring is the word I'd use there, Armando. And once again, if you want some excitement in your life, life is really boring. And then all of a sudden, a whole hell of a lot of history happens in just a very short time. Case in point, remember what happened in March of 2023 with all those bank failures, how one after another, the second, third, and fourth largest bank failures in U.S. history, all happening within a span of a couple of days. So sooner or later, yeah, the excitement is going to return. It's probably not going to be the excitement that you want, though. Thank you so much, Armando, for supporting the channel. And thank you to Nashville Pasta Man, who says probably no government jobs growth in the new jobs report. Yeah, I'm going to go out on a limb and say probably not a lot of federal government job growth. But I would point out, Pasta Man, in most of those jobs reports, the government jobs are predominantly state and local, because within government jobs, you're also talking teachers and firefighters. So I don't think we're going to see a lot of federal government job growth. That being said, state and local, that's always a big variable. You never know what could happen there. My big question with the jobs numbers we're going to get Friday, and we probably won't have clarity on this for several months, though, is this ridiculous pattern of huge negative revisions after the fact. Is that going to end? Can we please have some reliable jobs numbers from the BLS? Or, look, the Donald loves his stock bubble every bit as much as the last guy did. So are we going to get more of these ridiculous headline numbers and then we revise them lower by 120,000 the following month or over the span of the next few months? I don't know. I would hope we're going to get better numbers now. Maybe Elon and his Doge boys could look at the Bureau of Labor Statistics and what's going on over there. I just throw them out there. You guys do what you want with it. But that's the big question I have is, are these downward revisions going to stop with the new administration, or is that BS just going to continue? But I agree. The federal job growth certainly not going to be there in the coming months. We may even see some negative numbers. Thank you very much for supporting the channel, Pasta Man. And Mr. Millionaire. Thank you very much, Wes, with the Command and Conquer Generals icon there. He says, thank you for your daily diligence in consolidating data and accurately providing a daily dose of realism in economics. Well, brother, that is exactly what I'm going for. Thank you so much for the kind words, and you are most welcome, sir. I appreciate that very much. Thank you also for supporting the channel, and thank you, everybody, for having your coffee with the Melonheads. Guys, I promise sooner or later my voice is going to be back to normal, but today is not that day. Thank you for sticking with the channel anyway. Thank you for all the super chats and support of the channel. Thank you to my magnanimous Melonheads on Patreon and YouTube for supporting the channel as well. Links down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Until next time, everybody, live small and dream big. And hit that like button on the way out.